part 3 of the series, where today we're talking about lender's mortgage insurance. Lender's mortgage insurance is an evil necessity that allows us to borrow more than 80% of the value of the property. Now, so one of the things we need to talk about first is, well, lender's mortgage insurance is commonly called LMI, standard abbreviated, and it revolves around the loan to value ratio of the property, which is the amount of money you borrowed compared to the value of the house, and that's commonly referred to as the LVR, loan to value ratio. So, as an example, if you borrowed $320,000 to buy a house for $400,000, you're borrowing 80% of the value of the property, so the LVR is 80%. In that situation, you don't pay lender's mortgage insurance, and there's no other costs on the purchase other than your normal stamp duty, borrowing costs, things like that. However, if we borrow $360,000 to buy a house for $400,000, we're now borrowing 90% of the value of the property. And the same again, if we borrow $380,000 to buy a house for $400,000, we're borrowing 95% of the value of the property, so the LVR is 95%. How this calculates is that as a lender, you'll be able to borrow 90% of the value of the property. The mortgage insurance is calculated on the loan to value ratio and also the loan amount. So the more you borrow, the greater the loan amount, the higher the lender's mortgage insurance premium will be, and the greater the loan to value ratio will also equate to a higher lender's mortgage insurance premium. So the difference between borrowing 81% on a $300,000 loan and 95% on a $500,000 loan, they're the extremes of what you'd expect to pay. So as an example, in this scenario, buy a house for $400,000, we borrow $360,000. The mortgage insurance calculates to $7,054. That's added to the loan amount or capitalised, and so quite often people refer to the LMI being capped. That means that the lender's mortgage insurance is being added to the loan amount. So you're not paying mortgage insurance on mortgage insurance. So in this scenario, you'd actually be borrowing $367,000. The same at 95%, you can see that the lender's mortgage insurance has increased dramatically because we're borrowing a higher LVR, and that takes the total loan amount to $394,000. That sounds pretty cool, except most lenders will only allow us to borrow to a maximum of 97% with the lender's mortgage insurance capitalised. So you borrow 95%, add the mortgage insurance on top of it, but you can't exceed $97,000. 97%. In this case, we need $394,000, but we can only borrow $388,000. That means we need to find another $6,000 in the funds to complete. Now there are lenders out there who will go to 95% and allow us to cap the mortgage insurance up to any amount, in which case we could do this loan through that specific lender. So the information like that, and that's why I suppose when I use a mortgage broker, they can tell you which lender will allow you to use that loan, whereas the major four banks won't let you exceed 97%. In fact, quite a few of the lenders won't let you borrow 95% unless you're an existing customer with a 6-month credit history with them. And credit history means personal loan or credit card or car loan, something like that. So not every lender will allow any person to borrow 95%. Most of them will cap it at 97%. There are one or two lenders who will go to whatever it needs to be, whether it's 98 or 99%. Hope that makes sense. See you shortly.